Welcome to Wealthion. I'm your host, Andrew Brill. With the stock market having a schizophrenic time of it, there are other investments you can make that will bring a steady income with little downside risk. And we'll discuss that coming up right now. I'd like to welcome back Brent Rentmeester from our partner RIA WindRock. Brent is the founder and managing director of WindRock and has been investing and directing some of his clients to invest in real estate from a unique angle. Brent, welcome back to Wealthion and glad to have you here.
Great to be back.
So let's get into, I guess, real estate a little bit. And, historically, investors have liked to invest in real estate. Can you explain to us why that is the case?
Sure. Well, let me start at childhood. There's some connection to being a kid and thinking about real estate that starts with something as simple as the Monopoly game, where if you knew you got Park Place and you put a hotel on it, you were kind of golden in the game. So this concept of being a toll taker on something that's valuable. And also as kids throughout our life, we might see a corner building throughout our whole lifetime, and maybe it's 5 different businesses, and the businesses come and go, but the building's still there. So there's a certain permanence and stability to real estate that I think draws wealthy people in that are looking to preserve wealth, but also to grow it. So that's certainly one side of the equation. Because rents adjust upward over time with inflation or more, it tends to be a great inflation hedge, and hence also a cash flow generator. So it's a nice balance between protecting against future inflation, collecting cash flow now. And because it's been the domain of the wealthy for many years, there are tax policies that favor real estate favorably compared to almost any other investment. And that includes concepts like depreciation. I can write off the cost of the building and take that over time against gains. The idea that if I put, hypothetically, $100,000 in something, until I get $100,000 back, that's just considered my return of capital, no tax. Whereas if I put $100,000 in a stock and I get a dividend the next day, I'm paying tax right away on that. You're not doing that in real estate. And then you get up to the more elaborate 1031 exchanges and ways to defer, maybe forever, gains on real estate. So the tax policy is kind of the extra kicker on top of it.
But it doesn't have to be just the wealthy. If there's let's say someone starting out who's, out of college, is working and, not spending a ton of money, you can actually find some place, put a down payment down, and start your real estate portfolio, if you will, couldn't you?
Yeah, absolutely. That's still very common for people to buy a rental unit and build off of that. The other avenue, of course, are publicly traded REITs, so structures, public companies that own real estate. Have been much more popular the last 20 years. And then, when you're talking bigger scale things like owning an apartment building or a retail mall or something, then you're talking bigger dollars, private investing, and a little more sophistication. But yeah, all those things are a wide range of what can be done in real estate.
And Brett, I know that at WindRock, diversification of a portfolio is important. You're not putting all your money into equities. You're not putting all your money into Bitcoin or anything like that. Real estate can actually help you diversify your portfolio a little bit, and not only, as you mentioned, real estate, or REITs. If you don't want to go out and say, okay, you know what, I'm going to own this and rent it out, you can invest in a REIT and still gain some of that benefit, couldn't you?
Yeah, absolutely. The only caveat with REITs is because they themselves are publicly traded stocks, they're going to move around a little more with the volatility of the stock market compared to, if you and I owned an apartment building together, then, we don't really know what the value is till we sell it, but we're not going to see that fluctuation. But yes, I think real estate plays a critical role. And, there's some dynamics at play today that are different than at many points in the past post-COVID that I'm sure we'll get into.
How should an investor think about real estate? There's so many different angles, but there's the framework. How should an investor think about, look, you know what? I'm going to get into real estate, but I'm not going to live in that home. I'm going to use that as possibly some income.
Yeah, and it's a great question because framework for us is very important. And I think what I would say is, first, let's put single-family homes that people live in on the side. That's one category of real estate. It's a lot of people's wealth, but that's not what we're necessarily talking about here. On the other side of it is any real estate owned by third parties that are rented out. Now, there can be, I'll put those in two categories: real estate catering to more of a business, and real estate catering to more of a consumer. So on the business side, of course, you have things like obvious ones like office space, maybe even medical, data centers. On the consumer side, you've got, we use the term multifamily. Multifamily and apartments are an interchangeable term. So multifamily, clearly to the consumer. Retail, clearly focused on the consumer. Self-storage for your extra junk you can't fit in your apartment or home, clearly to the consumer. And even hospitality or hotels, clearly to the consumer. And then you've got one last one that's harder to fit in, which is farmland, an area we like as well, which is just kind of a food production, core asset for an economy.
So where is, and we're talking about investment properties, so probably places we're going to rent out. Where do you see the real estate rental market going? It's been, look, with interest rates where they've been, rentals have taken over. They've really, really risen. On a personal level, I'm looking for a place for my daughter to live at school for next year. I mean, she just got back, classes just started, and they're thinking about next year already, and the rents are crazy.
Yeah, the rents are crazy, and yet, for a lot of people, renting versus buying is still the better choice. I think to answer that question with a slightly larger lens, there have been some big impacts, obviously, during COVID and post-COVID. And I think the biggest impact on real estate is looking at maybe the carnage or the negative of what's happened in large part to big cities, including New York, Chicago, LA, Portland, et cetera, versus the Sun Belt states. And I think even today, I was just looking at data that in the 10 largest cities in America, this barometer is showing a 47.2% average occupancy rate in office buildings, so less than half. That's pretty damning. I mean, that's how do you recover from that quickly? So, I think when we talk about opportunity, on one hand, cities have had kind of a relative short-term bounce back because it got so bad, but I think the overhang is still a real problem because you've got huge occupancy issues. A lot of the cities, crime has become an issue, so now your wealthy residents are leaving in the tax base. And then, just the general cost of living, as you mentioned. It's not like things are dirt cheap. Okay, I'll go live in a city, there's more crime, blah, blah, blah. No, it's still very expensive. So then on the other side, you've got some positives. The industrial space, the warehouses, the Amazon kind of stuff has done very well. Medical's done very well. Challenges, those are priced to perfection right now. So is there an investment opportunity? I don't know. You're kind of buying at a point where everybody knows that's been a good thing. There are a couple opportunities. We still think, even though there's a relative lull, that multifamily apartment-type living in the Sun Belt states is going to continue to do well. I think Sun Belt states in general, because they offer, of course, Sun Belt, sunshine. They do offer better weather. They do offer more potential for growth, generally better tax policy, and generally less regulation. So, of course, you're seeing like Dallas versus California, or Texas, California. You've seen a lot of jobs move to Texas. Now, Texas has its shortcomings too, but I think thematically, when we look out the next 20 years, we're still going to see the Sun Belt states, kind of dominate the story. Now, there might be some values. You're seeing some of these office buildings change hands at cents on the dollar, but there's still a huge overhang. I think we're still very early in that cycle, and it's a little concerning.
There's I think that and correct me if I'm wrong, with interest rates starting to come down, there's a weird dynamic because interest rates went to a certain point, but so did home prices. I was reading just the other day that the median home price is over $400,000.
Right.
That prices a lot of people out of the market, but now with interest rates coming down, usually prices go up. But where does the bubble burst?
Yeah, I mean, okay, moving our lens to single-family homes for a minute, it has been an unusual period. We've kind of been riddled with this dynamic of, on one hand, inventories are low, and therefore, hey, if you're moving and you want to get in a school district and buy a house, you've got limited choice, and you're probably going to bid up to do that. On the other hand, the low rates we had a number of years ago seem to fuel housing to a pretty unaffordable level for most people, at least median income earners. So a lot of these cities, people have been completely priced out of even the entry-level house. And because of that, renting has really taken a front seat. And there's data showing that on average, it's much cheaper to rent right now across America than it is to own, when you factor in all the home ownership costs. And that condition doesn't always persist. So I think I would argue single-family homes are in a little more of a precarious position, even though the inventory is low right now. If you had a recession or any substantial downturn, I think you'll see continued weakness. Now, you are seeing some weakness in some of the markets that kind of boomed during COVID. I'll call it a cooling off period, from Florida to Texas, et cetera. I think that's temporary. Just like the bounce back in cities a bit, I think that's a little temporary too. I think there's still much more pain to come in urban centers.
So, given the single-family home prices and, would a correction in single-family homes affect multifamily, rental units and stuff like that?
Yeah. Yeah, a lot of people kind of think of them as similar because it's people living somewhere, but oftentimes they're driven by different dynamics. And so if homes sold off, people still have to live somewhere. It probably is because there's a tougher economic environment if single-family home values go down, and more people are either forced to rent or choose to rent. So I don't think, I think more often than not, weakness in single-family housing is going to be supportive of rental housing. Of course, there are scenarios maybe where both get hurt a bit, but I think in general, even though I have a concern that single-family housing is overpriced and comes off, I think we've been in a little soft period for apartments and multifamily, and I think by a lot of data, that's going to be bottoming this year or next.
So we are here at Wealthion, and we worry about investing, and WindRock worries about investing and making money and all that stuff. And you want to talk about a new opportunity that seems to be coming along, and that's build to rent. And that's a relatively newer thing, but these are places where you're seeing some opportunity to make a good amount of money.
Yeah, what I'd say is we're investors personally and with clients in this concept, build to rent. That's a terminology that nobody really knew until a couple of years ago. It's been a relatively new term, but we've been invested in this concept for over 10 years. And the simple idea is that a lot like Europe, we're going to become a little more of a rentership society. That was the premise 10 years ago, and I think that's proving true, and for a lot of reasons. Part of it is, as you said, Andrew, these homes are so expensive, young people, they're going to have to rent. But there are a lot of people choosing to rent, and they're choosing to rent for a variety of reasons. And it can range from flexibility of jobs. These young people might be in Dallas for 1 year of their career and 2 years in New York, and then they're in San Francisco. They're all over, right? So the premise of buying a home and getting settled only really works if you're there for multiple years. And we're even seeing it on the older end. I think somewhere near 2/3 of the rental growth between 2004 and 2019 was in the age category of 55 years and older. So people are repositioning their lives after 55. They're following their kids and grandkids. They're moving to new cities and saying, well, I don't really know this area. Maybe I'll rent for a while first. So with all that said, there's more of a demand for rental, but a lot of people still want a home-like experience. So the idea of built to rent is building a community from scratch, much like a single-family neighborhood, just a little tighter. So picture kind of a walled, gated community, and you drive in, and there's a pool and nice central area, and then there's little casita-style 1 to 3 bedroom homes. The caveat is these are just like apartments. They rent like apartments, so you don't put a down payment down. It's maintenance-free, but it feels like a home in the sense that most units are standalone and have a private backyard. it's pet friendly, all these things that a home affords, you probably get 95% of it in a community like this. So it's kind of this hybrid concept, maybe the new rental arrangement, or for a lot of people, as close as they may get to home ownership.
So these are actually single-family homes, and they rent just like an apartment would.
Yeah, it's a complete hybrid. So imagine, a lot of times in newer areas, you'll see a master plan community of a builder. It's just pure dirt, and they're building 300 homes to be sold. Imagine that, but now instead of that, they're building one of these communities. They're going to build this all up. These are always meant to be rented, so maybe it still has 300 little casita-style homes. It's always to be rented, so people never buy the home. It's not that kind of model. It's like you're renting it out, just like an apartment. Just like an apartment, you're getting annual rent. A benefit compared to an apartment as you're building these is they do these things in phases. So you're moving people in the first phase, even when you're working on phase 2, 3, and 4, versus if I built a 20-story tower in Chicago or something, I can't get people in until it's completed. And so it is a different concept, and it's one that's, I think, really resonating with tenants. They're 1 to 3 bedrooms, but like an apartment, they're financed like multifamily or apartments would be. And ultimately, as investors, when you go to sell it, you sell the whole neighborhood. You're not selling individual units. You sell, quote, the whole building, just like you would the high rise. So from an investor point of view, it's a great way to be in rental real estate. Like we were talking about earlier, some people have ambitions of owning a couple units and renting them out. That's great, but you've still got to be the landlord. You still need a repair person. You need to deal with issues of the property. If you want to be in something kind of innovative in that same lane, something like this, takes those pain points away.
So let me ask you this about these build to rent. So this is really, it's almost owned by investors. This isn't a builder goes in and, like you said before, builds 300 homes, tries to sell the homes. He's finished the homes, he sold them, he's out. Now these are done by obviously builders, but the builder is building it for an investor or a group of investors that are building the same 300 homes, maybe not as big, but they're going to rent these out for a period of time until they decide, you know what, valuable real estate, now we'll sell it off after we've made a whole bunch of money. Is that how that works?
Yeah, that's exactly the model. Andrew.
So explain to me the build to rent model. Help us understand the opportunity as an investor behind this.
Sure. I mean, what I would say is maybe to give a little context to that question first, renter preferences have changed over the last decade pretty remarkably. And we mentioned a couple things earlier, but there's been a tremendous drain from big cities to southern Sunbelt states. So that's one big change. Second big change is a lot of young people are seemingly preferring the flexible lifestyle of spending money on dining out and iPhones and whatever their things they enjoy are, over putting all their money in a home. Or said differently, they're choosing to rent closer to entertainment and their job instead of trying to buy a home an hour out on the edge of town. So a lot of those preferences are changing. The other preferences relate to things like pet ownership, like the communities we're involved with. Something like 70% or more people have a pet. So if you have a pet and you live in an apartment that's just up and down, there's not a lot of green space, it's difficult, right? The other thing is, I'd say similar statistics, 70% plus are female tenants. I mean, at least co-signing. And so because it's maintenance free, because it's a walled, gated, safe concept and has community, I think it really resonates with a female renter, and maybe even more strongly than a male renter. So from an investment point of view, you take all this together with these preferences, and you go, whether you're in Phoenix or Austin or Dallas or Tampa, if you're looking for a rental option for you or your child, and you're looking around, it's kind of apples and oranges. You're going to see, 20 apples, which is conventional apartment living, and 1 orange, which is, oh, this is different. This feels more like a single family home. It's got these different elements. There's a little dog park. things that may resonate. Now, it might be a slightly more expensive. From an investor point of view, the company we've invested with has a pretty good scale at this point, having done over 60 of these across the Southwest, Southeast. And, I think it's back to renting on paper economically is a better option than owning for many people, a growing percentage of people. So I think from an investor point of view, that's the concept. It's something that's not going away. You're probably going to see, we already have seen, but you're going to see a lot of people mimicking this concept in every major city in America. And at some point, maybe it'll be 10 to 20% of the rental options will look something like this.
It's interesting, and I get killed for saying this. The American dream is to build wealth, own your own home, mortgage free at some point, build that equity, and then when you want to move or retire, you can sell that home and have money. But that's changing, isn't it? Where people they're renting and still putting money away, and they haven't put that down payment down on a house. They've maybe invested that money and done well. So it looks like maybe, and again, I'll get killed in the comments, but that's okay. The American dream is changing a little bit.
Well, I don't know if it's totally changing as much as it's just unreachable for many people at the same age. So maybe you could afford your first home at 25. Well, now maybe someone still can, but maybe they're 40 now. Well, that's another 15 years of renting. So I'm not suggesting home ownership isn't a good path. I think it is what's built America and made communities, had people taken ownership of their communities. I'm just suggesting that the reality of where prices are at with single-family homes is such that many people can't get there, and this is a close second in the sense that it offers a lot of amenities that feel more like single-family home living. You don't build up equity, though. So I would never discourage home ownership. Real estate's always local. Someone might find a great local deal, but the national statistics right now is it's almost $1,000 more per month to rent than own, and that's across many cities. It varies by city, but in a lot of cities, I looked at Phoenix recently, 50% more expensive to own relative to rent based on some of this criteria. So I think people are going to vote with their pocketbooks, so to speak, and when they're young and have other expenses and are trying to live their lives and enjoy things, they're probably going to be renters for a prolonged period. And if we can find an investment that caters to that audience, gives them something I'd call special, closer to home ownership like feel with a community, I think that's a good value. What we're not talking about, just by the way, we're not talking about big Wall Street firms buying up people's single-family homes and renting them out. I'm not in favor of that model. I want, personally, selfishly, home ownership in America to be individuals. This is akin to apartments. It just has a different feel.
So I guess my question is, how do I find, this sounds like a great investment. I mean, obviously it's going to give you a return because there's rents that continue to, pile up. How does someone like me, an individual investor, not working with WindRock, how does someone like me find these things? Or is it usually you have to go through, WindRock or another investment, management company that's has these deals?
Yeah, I think, again, it's how do you want to approach real estate? There are publicly traded REITs, real estate investment trusts, that trade as stocks. So somebody can find, theoretically, an apartment REIT and that, put a small amount of money in. When you start talking about these private kind of investments and communities, it really is dependent on knowing the space, knowing the operators, and being with the right partners. I don't want to say all are equal. Real estate, as we said earlier, is a very local business. So, for example, the ones we're involved with, in Arizona, they have local Arizona teams. In Florida, they have partners in Florida. You've got to use local specialists that know the market for renting it out, know building conditions, et cetera. And so, generally speaking, unless you're great at your own due diligence, finding an advisor or someone that can navigate that space. And, one other point, just thinking about due diligence that makes this kind of an interesting, attractive space is private real estate can take you a lifetime of due diligence, meaning there could be a single property that you're trying to analyze and see if you should buy. It might take you 6 to 12 months to do the work on that. Then you buy it, great. Now you're on to the next one, start it over. This is a little more of a repetitive kind of assembly line approach to investing, because these communities, although they look and feel and have different local touches depending on the market, different, differences, conceptually they're the same bones inside, the same model. So we think of it more as an assembly line business. I'd say the last real estate concept I recall that did something like this was self-storage, which I remember in the early 80s, you started to see this pop up. And believe it or not, here we are, years later, and it's still a growth industry. And that was a good example of a rinse and repeat kind of model. If you found the right formula, you could do that in, 100 different markets. And so I think we're seeing something similar here. So there's also a benefit to an investor of, you don't have to redo the due diligence and rethink it. You have to find a model that's working, that resonates with you as a good solution, and then you've got to take it to different markets.
Yeah, and if you missed the photos, we put up the photo of what a community might look like that Brett supplied us with. And it's pretty interesting because as a young child, I used to visit my grandparents every summer, and they were in Florida in a retirement community. You had to be over 55 to buy into this community, but it looked just the same. There was a community pool, and all the houses looked very, very similar, but it was all people of a certain age or older, my grandparents, and you used to just visit, and the houses are very close to each other, but it was your own home. It was a 3-bedroom home, and it was pretty interesting. So the investment part of it, being able to give you, rental income for a good period of time is pretty interesting. And this sort of eliminates like you said, the legwork that you have to do of, going and finding a home, making sure it's sound, buying it, and then find tenants for it that can be there for a long time. Once you invest in these build to rent places, your work is done. You've made your investment. The experts take it from there, and you just reap the benefit, I would assume, right?
Yeah, I mean, generally that's right. You're a passive investor, so you're not getting your hands dirty.
So with all these, and this is generally in the South right now, do you see it moving towards the North and places? I mean, you're in Chicago, I'm here in New York, but I would assume there are places in Illinois, in New York, where this would actually work.
Yeah, absolutely. The firm we've worked with had the premise that the Sun Belt states were the opportunity. So we're largely invested in states such as Arizona, Colorado, Texas, Florida, Georgia, those kind of regions. Conceptually, this works anywhere. We've seen it. Where it doesn't work is in an urban center, because we'd call this low density, meaning you need some land to build this. We're not going vertical. This isn't a 40-story tower. So it's more of a suburban concept. It's kind of infill suburban, meaning being by job corridors and entertainment and close to the amenities people care about. So we have seen a tremendous increase in this. There are many people in the marketplace. The group we're invested with is one of the early innovators, but I think this is going to be more of a staple of just rental living across America, and you'll probably see it in your area if you haven't, by somebody.
So my question, Brett, and I bought my first home young, and I'm not going to get into age because you'll know exactly how old I am, which is old, but does it still pay to buy your home? Or is it, are we turning the page towards, what, economically, you should just rent and figure it out from there? And I think when you supplied us with a chart and when I looked at the chart, I know when I was younger, it definitely paid to buy your home. But what is the trend like now?
Well, it's based on the data at a point in time. So the criteria to buy a home goes well beyond the economic, thought process, right? Because you might want to be in a school district. You might be starting a family. There's all sorts of reasons that go beyond the economics. But just the economics today caution that single-family home prices are so elevated. And interest rates went up. They've come down a little bit, but they're not they're not at 2% anymore, 2.5% for a 30-year mortgage. So it's a question of affordability, and it's still going to make sense for a lot of people to buy a single-family home. There's no question. However, I think the data suggests you have to be very careful not to overpay, and you have to be very careful not to overcommit and have such a large percent of your income get sucked up in just basic expenses for a home without, proper reserves for repairs and if things go wrong. So I don't think, I don't think it's suggesting single-family ownership is dead. It's just flashing a red warning, like maybe in '06, that values are very, very elevated, and they've come up a lot, tremendously in the last number of years. So it's, I don't know, maybe we'll be sitting here in 3 years, we'll have had a housing correction, it'll be a great time to buy. So I think it's kind of a dynamic process. But right now, looking at the data, there's definitely caution in the wind to being a buyer.
So what is the forecast for this sector? Obviously, I own a home, but the build to rent and renting, what's the forecast for this sector?
Yeah. Well, it's, again, told through the lens of COVID. You had a lot of people moving to different cities, states that they hadn't lived. So you had a big migration, and you had a lot of Sunbelt areas boom and a lot of cities hurt, and you had a little reflexive bounce the other way now, where the cities have stabilized a little and you've had a little sell-off in some of these other markets. I think, over the last 2 years, there's been a little pause on activity in a lot of real estate because rates have come up a bit, and rents in general have been pretty flat. Now, if you go back to 2022, it was the opposite. Rental rates were up 25% in 1 year, and rates were low. So things kind of ebb and flow. I think as you look forward, one of the negative overhangs is periods where things get too overbuilt. And a couple of years ago, we were in a period where money was cheap and available, and a lot of people could get credit to build things. And that does create the risk that certain areas get overbuilt or bad projects get put up that compete with yours. I think when we look at the data, it's interesting. We've kind of swept this under the rug, but last spring, 2023, we had this, I was going to call it a mini banking crisis, but it was a real banking crisis. It just got swept under the rug so quickly with the bailouts. But Silicon Valley Bank, some of these other banks. But what that led to is a massive pullback of available credit, mainly to people building any type of real estate. So since that peak activity, supply is down almost 70%. In the first half of this year from that peak level. So the data we look at suggests that maybe we've got another year or so of a little bit of absorption or time it takes to get new units rented up. But by 2026, it's starting to look like you've now got a supply problem in a lot of these growing markets again, where there's just not enough units coming to market to rent versus the demand. And in large part, that's because of the financing backdrop. It pulled way back. People can't get the right credit. Therefore, less gets built. You don't feel that immediately. So if that's a banking crisis in 2023, fast forward 3 years for the leg of projects getting approved and built, and now you're in 2026. So I think there's a pretty bright future in the right markets with the right concept as you look out a couple of years.
So what does the return on the investment look like? Now, is it a one-time return where, okay, we invested X and they're giving us our money back once this is built? Or do you get ongoing pieces of that rental properties?
Yeah, no, it's a great question. And to break that up, oftentimes in development, there's a couple-year cycle of getting things built and leased up. So let's call that, for what we're doing on average, 2 years. At about the 2 to 3 year mark, it's leased up, it's a full community. Now you go back to the bank and you say, hey, look, this used to be desert dirt. Now it's a cash flowing full property. They value it much higher, and you refinance it and generally kick back a fair amount of money at that point. But again, because of the positive attributes of the tax law, most of that is offset by depreciation or considered return of capital. So you get good amount of your money back in a perfect, hypothetical thing. And then from that point on, you're getting rental income for a number of years until you ultimately exit and sell the building. Now, the biggest pop of return will generally be at exit. For the communities we've been involved with, these are generally 2 to 5 year kind of windows of time for getting money back. Versus there are plenty of real estate deals we look at where someone's investing in an office building and it's a 25-year proposition. So we find a lot of investors that want to be in private real estate, they just don't want to tie their money up for decades. So I don't know if that answered your question, Andrew, but that's kind of the profile of it.
So you're investing, and you say you get the biggest pop when they sell, but these build to rent units are not being sold.
Well, no, that's not entirely true. I mean, the general idea is to build them, lease them up, kicking out cash flow, and then either exit them, either sell specific communities if the value's right, or what this operator's done in the past when rates were low, instead of selling, they were able to do what's considered a recapitalization, which is, okay, you bring in other lenders at a low cost, the values are still up, and you kick a lot of the capital out, that you would have upon a sale, but you still haven't sold it, you still own it. And so real estate affords that kind of luxury. Sometimes you're going to be a seller, sometimes you're going to have higher appraisals, get new loans, and be able to kick back profits and gains without truly triggering a sale. So I think it's very dependent on the operating environment, but that's one of the benefits of real estate. You can kind of play that game for a long time if you want.
So these build-to-rent communities, they're actually sold from like one investor to another. You don't take a build-to-rent community and say, okay, now I'm going to sell them off as individual houses.
I'm not saying somebody hasn't tried that, but the ones we've been involved with and what I've seen in the marketplace is more like thinking of it as one community. So it might be a neighborhood of 300 rental homes. That's akin to buying an apartment with 300 rental units that's 20 stories high. It's financed the same way, similar types of buyers, institutional buyers. So picture one pension fund or institution or even family office wealthy group coming and saying, hey, we would love to own rental properties in Phoenix. We like the dynamics here. That might be a buyer.
So they buy the whole community, and then you cash out at that point.
That's right. Because, listen, ultimately, there are investors. People don't want their money tied up indefinitely. I think, and I assume other operators work this way, but the partner we've worked with generally will give people choices. Like there might be a point that they refinance, that they can bring in other capital and kick a lot of money out, but still own the property. But if anybody wanted out totally, then you pay them out at that point when there's an appraisal. So, real estate offers a lot of those positive dynamics. There's still risks. No investment is risk-free in this world, and we're in a pretty uncertain world. But I think if you come back to basics, shelter is a major component. People are going to live somewhere. So you've got to find the right location based on city, state, policies, et cetera, that we talked about earlier. You've got to find the right location. Where do people want to be relative to where the jobs are at, where the entertainment's at, where they spend time? And you've got to have the right operators that can build it and operate it the proper way for economic success.
Awesome. It seems like a great opportunity, and it's funny you said something that younger people, they move around, they move jobs to jobs, so they don't want to. It reminds me of a sport, sports where the anomaly is the player that plays for one team for their entire career, and it's almost like professional sports is taking after the younger generation now, where they'll move from team to team, and now kids are moving job to job.
I think that's right. It really permeates across a lot of our society. And even as I mentioned earlier, even people that are retiring that might have in the past just gone to a place in Florida are now saying, yeah, okay, we have a place in Florida, but now I've got a daughter in Nashville and a son in San Francisco, and we want to be closer to grandkids. So even those demographics are thinking more flexibly in our experience.
Yeah, I hope to have grandkids in certain places someday, but that's a little ways off. But Brett, where can we find the research that you guys do? I know it's windrockwealth.com. Where else can we find you guys?
Yeah, I think that's the best portal where we post all our research interviews. We're out there on Twitter, we're out there on LinkedIn. you can find us. But I think a good starting point is windrockwealth.com.
And if you're interested and you want to find out more about what Brett does, certainly hit us up on Wealthion.com. We will point you towards Brett and Chris and Brandy over at WindRock, and they will help you invest in real estate and other things. It's not just real estate. You manage the whole portfolio. So, thank you for joining me and talking about this. This is interesting, and it almost feels like I want to go out and buy more properties, but I'll refrain from doing that for the time being. I still have college and medical school to pay for. So,
Great talking to you, Andrew.
Yes. Thanks, Brett. Appreciate it.
All right. Take care.
Thanks so much for watching our discussion here on Wealthion with Brett Rentmeester. If you need help being financially resilient, please head over to Wealthion.com. Hit the button in the top right corner that says Find an Advisor and sign up for a free, no-obligation portfolio review. And if you could like and subscribe to the channel and turn on notifications so you know when we post new videos to the channel, we'd greatly appreciate it. And please do the social media thing with us. All the links are below in the description. And if you like this content and are looking for more ways to achieve long-term wealth, watch this video next. Thanks again for watching. Until next time, stay informed, be empowered, and may your investments flourish.